The car market has a major problem. People are saying it could completely collapse, taking down the rest of the economy with it, the Great Depression for cars. I needed to find out for myself what in the world is happening here. So I started with the fun part, car shopping. And of course, my lizard brain quickly went from market research to picking out rims on a Lamborghini. I personally like the silver ones. Then I got back on track, and the commonalities between these cars started to pile up. I was nips deep in a blizzard of chip shortages, high interest loans, crazy laws about lending, repos, and even the bond market. Not that kind. Bond, not bondage. I quickly realized the auto market was rapidly heading towards a brick wall at full speed, and something's not right here. Straight away, prices are high, like way more than I expected. I own one old beat-up car and a fleet of box trucks, but I haven't really been paying close attention to prices. And this isn't just new cars. Used cars with tons of miles are also selling at a premium. So I started looking back over the past few months to discover that prices were even higher just a few months ago. It turns out that lockdowns and pandemics are bad for the car industry. Who would have guessed it? But soon after lockdowns, starting in 2020, car makers stopped production and canceled their orders for new microchips. And it turns out a new car needs like 100 of these things. So production ramped way down. And then came stimulus checks. And they did exactly what they were supposed to, stimulate the economy. This did something weird that I'll explain in a minute, but people started buying cars again. So car makers ramped production back up. Then just about everything that could have gone wrong did. Resources to build these things were now hard to get. 2 different car microchip builders started on fire. Then a Texas blizzard shut down even more manufacturers. So there was way more demand than supply. The average price for a new car was over $47,000 in May, up 13% in 1 year. Then because a lot of people either couldn't afford or find a new car, this jacked up used car prices. And I mean really jacked up the price on used cars. They averaged $30,000 at the end of 2021. This price chart says everything you need to know. Obviously, this isn't sustainable, but does that alone mean a car bubble will pop? Probably not. So I began to wonder how people were even able to afford these crazy prices. And the answer is high interest loans. This might be enough to cause a total market crash, but I needed to dig deeper. So I was on the computer and I found this weird little trick. People who would typically have a hard time getting a loan were often given the chance to use their last month's income on the application. And this seems harmless and fairly obvious, but stimulus checks, those counted towards income. And lenders were cool with not looking too carefully at the details for the sake of making a deal. But why? Weren't the lenders worried about lending to someone who might default on their loan? It turns out not really, for a few reasons. First, insane predatory interest rates. 25% APR is not an uncommon rate. Heck, 75% isn't unheard of. Let's pause for a moment and think about what 75% APR looks like. Let's say you buy a 2006 Jaguar for $5,350. You put $2,000 down and take out a loan for the remaining $3,350. Let's say it's a 3-year loan. At the end, you would have paid more than $10,000. Total interest of $5,000 on a $5,000 car. And this isn't hypothetical. This actually happened to someone, and that's not it. Loan duration has increased as well. Where a typical loan used to be 3 to 5 years, now it's much more frequent to see 6, 7, even 8 years. And while this makes monthly payments lower, buyers end up paying way more in the end. Using that Jaguar from earlier, if they had a 7-year term instead, they would have ended up with $14,000 in interest on a $5,000 car. Now, this is wonderful for one group. The lenders. They're just rolling in that sweet passive income from your extended length loan. But of course, that's only true if you keep making your payments. Aren't they worried about that? Again, not really. Cars are easy to repossess. In fact, many lenders require you to have an electronic tracker to be installed in your car until the loan is paid in full. Stop paying and they'll just send a tow truck to come pick that thing out of your driveway. Now they get all the money you already paid, plus they get to sell that car to someone else. And here's where I got confused. Aren't there supposed to be some government protections for consumers and borrowers? Trying to answer this question led me down another extreme rabbit hole. It turns out that there's no federal rules regarding maximum interest rates on auto loans. It's all up to the states. So for people of these states, good luck, because you have no auto loan rate limits. And for everyone not living in those states who just breathed the sigh of relief, you may want to suck that one back in. Each state is different, but there is one consistency. that they're all very inconsistent. For instance, New Mexico protects its citizens by allowing only a 175% interest rate on auto loans. Oregon has a nice 36% limit for loans from banks, but loans from car dealerships have no limit. And Florida, which has an 18% interest cap on auto loans, has another law allowing car dealers to charge much higher. Guess who the court sided with on a dispute on that one? Here's a hint, not the woman who got stuck with 27% APR on a 2004 Pontiac. After coming to terms with the fact that the system is set up to protect lenders, not borrowers, I decided to look at what this means for all those folks who got high-interest car loans during the pandemic. And what I found has implications for the entire auto industry and the economy. It's repos, lots of repos. There have been 2.2 million cars repossessed so far this year, which is the same number for all of 2019. Repos on so-called subprime car loans are up 11% since just 2020, and the recession is just getting started. The reason that this matters, beyond the fact that many people are losing their cars, is that the cost of used cars has been declining. And don't get me wrong, the cost is still ridiculously high. But now lenders, whether they're banks, credit unions, or dealerships, will likely have to sell cars at a loss. I know. Poor banks and lenders always getting the short end of the stick. But there's more to this story. You see, during the pandemic, lenders gave out loans with high loan-to-value or LTV ratios. The LTV ratio is the amount of the loan divided by the value of the asset. In this case, the value of the car. If you have a $5,000 loan on a $10,000 car, the LTV is 50%. Now, an 80% LTV ratio is normal, but the pandemic was not normal. So we saw many loans at 120 to 140% LTV. That's like having a $14,000 loan on a $10,000 car. So if the car is repossessed, lenders could actually owe more money than the car is worth. And this is compounded by the fact that prices are falling for used cars. And I'll be honest, I don't have a whole lot of sympathy for lenders who jack up interest rates or loan to people that they shouldn't, but this got me thinking about how most people felt about banks following the 2008 crisis, and how even though the banks were the ones making bad decisions, it was the whole country that suffered. Part of the reason 2008 was so destructive was thanks to manipulations of the bond market. Subprime mortgages were packaged together and hidden among healthy mortgages, then sold as these nice AAA rated mortgage-backed securities. It was like this nice investment burrito, except hidden inside the burrito was a few pieces of investment dookie. We all know how that panned out. But it's a good thing that there isn't the same kind of dookie investment burrito for auto loans as there was for housing loans, right? Right? Oh, They don't even call them dookie burritos. They're called auto asset-backed securities, or auto ABS if you want to sound cool. But they work pretty much like mortgage-backed securities. Auto ABSs are created when lenders sell their loans to a financial institution. They're then bundled into a portfolio to sell to investors who make money off the repayment of these loans. And these auto ABSs are a hot commodity right now.
That Hansel's so hot right now.
Corporations have already sold $58 billion worth so far this year. That's 36% more than in 2020. This is despite the fact that asset-backed securities of all kinds typically take quite a beating during economic downturns, which we're in one right now. Their justification is that even though used car prices are coming back down to earth, new car prices are still rising. However, I think the risk of this is severely understated. Record numbers of people are defaulting on their loans, and this is only likely to increase considering the ridiculously high interest rates many people are paying. We've seen that lenders put themselves into vulnerable situations on their high LTV loans, and the odds are we're in the beginning of a recession right now, which means this whole thing just could get worse. Now, I do have a few thoughts about what we can expect next and what you can actually do to save some money, but before I do that, real quick, I need to tell you about today's sponsor, iTrust Capital. With iTrust, you can actually place your crypto in a Roth retirement account. This means you can buy, sell, and trade crypto and pay no capital gains on your wins. This is absolutely amazing for traders. With the Roth, you pay your tax upfront when putting money into the account, and then at retirement, you pay no tax once you start pulling out at age 59 and a half years old. This is probably the most simple way to save on all capital gains taxes. They'll be linked in the description below, and if you use that link, you'll receive $100 in Bitcoin for free just for joining. Now, if you're thinking about buying a new car, maybe wait. It could save you a significant amount of money. Prices for both new and used cars are likely to come back down to earth at least a little bit in the next 6 to 12 months. The question is whether this will be a gradual decline or a straight up bubble popping. But if there's an auto bubble explosion, will this just crush the rest of the economy? It won't be good for sure, but I don't see it taking down the entire world with it. Total consumer auto debt is about 1.4 trillion. Let's say a bubble popped and 500 billion of that collapsed. This would still only be about 10% of the loss of the dot-com bubble. So as long as you're not paying 75% interest, you should generally be okay. Unless, of course, the auto industry is just the first domino to fall, causing much larger industries to also collapse, leading to the entire economy to free fall into a pit of despair. But until then, I'm Max Maher. I'd like to thank you so much for watching, and I hope you have a profitable day.